Okay, hello everybody, and welcome to our workshop on the basics of investing. My name is Jacob Arbogast, and I am the director for the Center for Excellence in Finance at Chico State.
Hi, my name is Pranav Patel. I'm a paraplanner here at Chico State. I also work at the Financial Wellness Clinic.
And so this presentation is going to cover the basics of investing, and we're going to talk a little bit about how to select a broker, how to kind of evaluate what kinds of things might need to be in your portfolio, and look at some of the risks and pros and cons of getting started with investing. But before we do that, first thing we need to talk about, because we're going to talk about investment topics, we just want to have a quick disclaimer to make sure we're all kind of on the same page, in that we will be discussing investment planning. It is general educational material for the community. It's designed to be for the public in general and not for you specifically. So we want you to know before we start talking about anything that all investments do involve some amount of risk. You should consult with a financial professional about your specific needs before you start investing. But this presentation hopefully will kind of help you to get started if you maybe don't know where to begin, or you're just getting used to the idea of starting to invest.
Hey, Jacob.
Yeah.
Will this presentation teach me how to day trade?
No. So we're not going to be doing any kind of day trading or any kind of high risk analysis or anything like that. We're just going to be talking about the basics and how to get started.
Awesome.
Good question. So when we get started investing, there's a few things that you might want to ask yourself so that you know kind of what you should be looking at and kind of what direction you should be going. So some of those questions are financial planning related. So Pranav and I both work at the Financial Wellness Clinic at Chico State. And one of the things that we do at our clinic is we help people with budgeting, paying off debts, managing their finances. And those are the kinds of things that you probably should ask yourself before you start investing. Do you have an emergency fund? Are you prepared for any of life's emergencies financially that may come at you? Do you have some disposable income that you can use towards your investments? Money that if it goes down in value, because some investments will go down in value, would that cause undue harm to your lifestyle? If it would, then maybe investing isn't the right course of action for you right now. And then maybe ask yourself, what are your investment goals? Saving for the long term. If it's retirement related, investing for retirement, and you have many years to go before you're retiring, then that would require one set of goals. But maybe you have some children who are going to be going to college soon, and so you want to invest some funds to have a college fund for them. And if that's in the short term, maybe they're going to be going to college in the next maybe 5 years. Well, then that's going to be an entirely different investment goal. 5-year time span is very different than a 30-year time span if you're looking maybe at retirement. And then how much risk are you willing to take on in your portfolio? We said at the start of this that all investments do involve risk, and that's true. Not only do all investments involve risk, but different kinds of investments have different risks associated with them as well. Real estate, for example, owning a home, a rental property, will have significantly different risks associated with it than owning a bond, right? A government treasury bond, for example, is a very different kind of risk than real estate would be. And so these are just some questions that I can't answer for you. You have to answer for yourself, things to think about before you get started. But once you have looked at those and kind of evaluated your own personal finances, then we can go ahead and get started there. So the first thing you might want to do is select a brokerage service. That's going to be the first thing after you've evaluated your finances. Where will you begin doing the investing? And so there are many different kinds of brokerage services available. And a broker really is kind of a fancy word for somebody that connects to things. And so when you're investing, you're going to be buying or selling some kind of investment. And that could be stocks, it could be bonds, it could be all kinds of different other investments. And so a brokerage service is the person who is very similar to a bank account, actually, in which you would put money into a brokerage account. But then from there, rather than the money just sit there, you might use those funds to purchase something like a stock or a bond. Some brokers, there's different kinds of brokers, and some brokers are full service, which means they might meet with you. They might have an advisor that works for their firm that could meet with you, give you some recommendations on the types of investments that would work for your investment goals, for your lifestyle. Some brokers are called discount brokers, and those are ones where they really just provide a website and a portal. You can log in, you can manage your account, similar to how you might do online banking, with your bank. And so you could, if you are comfortable doing it with a discount broker, you could manage your portfolio by yourself, choose your own investments, choose your own stocks, bonds, mutual funds, anything like that, and manage the portfolio all by yourself. You should weigh to decide, what kind of broker you need. You should weigh your experience and what needs you have, right? If you need somebody to kind of help you because you don't have a lot of experience in this area, there's nothing wrong with that at all, but you might want to look at a more full service brokerage option. If you're very well experienced and you know exactly what you're doing and what you need, then a discount broker probably could serve you quite well. So there are some recent trends in brokerage services, and that's every broker historically would charge their own fee, but the trend now is to have a $0 commission, and a commission is the amount of money that you would pay when you have a transaction. If you're going to buy a stock, a bond, a mutual fund in your brokerage account, they would charge you a fee for that, and that's called a commission. But lately, most brokerages have gone to free or $0 commissions, and that's pretty common nowadays. So brokerage fees are something to think about. Typically, you might have a commission. There may be some brokers that do charge commissions, but lately they're $0.
Jacob?
Yes, Pranav.
How did the commissions go to $0?
So maybe 2015 or 16, I don't remember exactly what year, but there was a broker, or there still is a broker called Robinhood. They came out with free commissions on their trades. And prior to that, it was pretty common to have maybe $3, $4, $5 transactions, maybe even $7 commissions for most online brokerages. And they would say, I know there was a very famous one that was $4.95 per transaction, right? And that was a very common thing. But when Robinhood came out and had $0 commissions, it kind of upset the market a little bit. And they said, well, if this one firm is offering $0 commissions, why would anyone be willing to pay for a service that someone else is able to do for free? And so it kind of drove the market to be zero commissions for the industry. And so it's very common now, if you're just utilizing the website to buy and sell stocks, bonds, and mutual funds on your own, and you're not interacting with a live human, there's very little cost associated with the brokerage firm doing that because it's all on their website. And so they don't need to charge a fee to maintain very much. And so there's a $0 commission there. There are some brokerages, even if they have a $0 commission for using their online services, they may charge a fee for using their one-on-one services with an advisor from their firm. And so there may be a fee associated with that, and you should check for that before you decide what broker is right for you. So in addition to brokers, there are also investment advisors. Those are different than brokerage firms, but they are very similar in that all of these things, brokers and advisors, all fall under the industry of financial services. And so they all offer financial services and financial information. Many firms actually are brokerages and investment advisory firms. They do both. And so some investment advisors will be able to advise you on what investments should be in your portfolio, and then also offer the brokerage services to be able to build that portfolio for you. Many investment advisors, similar to how brokerages would have an advisor within their firm, if you go to an investment advisor, they would charge a fee for their services. And depending on the kind of advisor they are, they may charge fees based on different systems. A very common way to charge fees as an investment advisor would be what's called assets under management. Usually that's abbreviated AUM, assets under management. And that's a percentage fee based on the amount of money that you invest with them. So it could be something like a very typical number would be like 1% of assets under management if you're around $1 million portfolio. And that might be something like you're saving for retirement, and you're maybe you're not yet retired, but you're kind of later in life and you're nearing retirement. You have saved up $1 million as your nest egg. And then you have a 1% fee per year for them to manage your money for you. And so That's one way that financial planners often charge fees, but they also end up having kind of what they call breakpoints, where it would be if you have more money invested with them, you get charged a lower fee. And if you have less money invested with them, you might get charged a higher fee. And so if you had, like I said, $1 million with a 1% annual fee associated with that, that same advisor may have a breakpoint. If you have $5 million invested with them, they may charge 0.5% per year. Or if you had less money, say, a few $1,000s, they may charge 2% a year, something like that. And the actual fee is going to be unique to every investment advisor. There's some trends, but every advisor can decide for themselves what fee they want to charge. And so you can kind of compare services and costs between different advisors if you're searching for one that will meet your needs. Some investment advisors do also charge a flat fee, and that's something that has become more popular lately. And that's where you would charge or an investment advisor would charge a straight dollar amount, say $1,000 or $2,000, and they would create a financial plan for you or for you and your family, and that would be given to you almost as similar to like a binder or a bound plan, and it would be a lot of different services kind of rolled into one. It could be very complex, something like you should create a trust for your family, and you should buy and sell this real estate, and you should have this kind of portfolio and this level of insurance. And it could be very complex, a full scope financial plan for you and your family. And so there are investment advisors that will say, I will create this plan for you. You can pay a straight flat dollar amount and then take that plan and do whatever you want with it. You can implement it yourself if you're comfortable doing that, and you take essentially this instruction booklet and implement that in your own life. Or you could then choose to hire that financial planner who created that plan to help you implement those steps as well. And so it definitely depends on your level of experience and what works for you. But those are a couple options available that you might want to consider. So there's a website before you decide what broker and what investment advisor you want to work with. A website called Brokerage is available. It's operated by an organization called FINRA. FINRA is the financial industry regulator in the United States. They work very closely with the SEC, the Securities and Exchange Commission, to oversee a lot of the financial services industry. So Brokerage is a website that any of us can utilize. It's publicly available. In fact, we're going to go look at it in just a second to see an example of somebody on Brokerage. And what you would do is open the page. You can look at the history of a stockbroker or an investment advisor and see some information about them. So let's do that real quick. There's a link on here.
Hey, Jacob.
Yes.
Brokerage is a free website, correct?
It is. It's absolutely free. And so I'm pulling it up right now so that we can see it. And Pranav, you can see this, can't you?
Yes.
Yes, perfect. So what I did is I pulled up somebody who I think is pretty well known, although maybe not everybody's heard of him. This is Bernie Madoff. He was very a public figure just after and during the financial crisis. And he was, you can see on here that he's been barred from working in the financial services industry because of a lot of fraud and crimes and stuff. And so I don't want to recommend in favor of or against anyone, but I thought this would be a pretty fair representation to show, here's a way that you can look up a broker without me having to make any claims directly. And so what you'll see on the Brokerage website, you can search. I'll start at the top and kind of work my way down. You can search if there's any particular stockbroker or investment advisor that you want to search for. You can search for them by name. You could even search for them by company, and you can just look up the company that they work for and all of the different employees that work there. Or you can look by a certain city, state, zip code, or any geographic region that you're in. You can search that way. You can search specifically by firm. Those are both available. Now, this report for Bernie Madoff, this will be true for anybody that you look up on here. You'll have a list of disclosures. Now, for Bernie Madoff, disclosures are things like financial crimes, but for the general investment services, financial services industry, disclosures might be something more like a conflict of interest that they just want you to be aware of, or something that's happened in their past that maybe doesn't actually apply anymore, but they permanently record these disclosures on here for the benefit of the investing community so that we can all see what's happened in the past and we can make more informed decisions. You'll be able to see their experience and the number of companies that they've worked for. Now, in Bernie Madoff's case, he just worked for one firm, which was his own firm, his own company. If I scroll down here, you can see that it was Bernard L. Madoff Investment Securities, LLC. That was the company that he worked for his entire career, 1960 to 2009. He worked there for 49 years before his firm collapsed in 2010, 2009. You can also see any regulatory exams. And so every broker and every investment advisor, if they are licensed to give investment advice, will have passed some sort of exam related to their licensing. There's different kinds of licensing available, whether it's for being a broker, a stockbroker, whether it's for advising on investments or managing things like commodities or mutual funds or things like that. There's different kinds of exams. And you can see how well qualified your advisor is there. And if you scroll down, you can see any of those disclosures that we mentioned earlier. So you can see there's quite a few for Bernie Madoff. Of course, he was a fairly well-known public figure during this scandal that was happening. And so you can see down here, this is some of the criminal charges that are being disclosed to the investing public. And it's for these reasons that the SEC decided at the top up here, the SEC decided to bar him from the investing industry as a whole. And so that's just some of the information you can get from BrokerCheck. I think it's very useful to be able to look up this information for any broker, is hopefully for somebody who has a less serious reputation, a less serious history. But you can look this up for anybody or any firm related to your investment advising. So making investment decisions would be the next step. So we all want to build wealth over time. We all want to make sure that we can, build our portfolio and save for the long term. There are some things that we want to think about. So investing is going to involve balancing your risk and your expectations. And so there are different investments available. All of them we've mentioned earlier, all of them come with some different kinds of risk profile. Stocks and bonds have vastly different risks from each other. Mutual funds can have all kinds of different risks, real estate, cryptocurrencies even, or all kinds of other things. They all have different risks associated with them, but they also have different expectations for profit. You may be very profitable in one area and maybe not necessarily as profitable in another, but it also might come with less risk. Some investments can earn a lot of money. They could be very risky. There are very few investments that are extremely profitable while also being low risk. That's just not a very common thing. Maybe you've heard in the past that there's a balance of risk and reward. There's a risk reward trade-off. And that's true with essentially all investments. If you're willing to take on a little more risk, you may be able to get more return. But if you're not willing to take on risk, then you might not get very much return. So there are different kinds of investment options available. So in the investment world, we call these asset classes. So some examples of asset classes might be stocks, bonds, traditional currencies like the yen and the euro and the dollar and the pound, derivatives, which are a lot more complex and definitely outside the scope of this presentation, but derivatives could be futures on commodities, things like gold and corn and oil, those kinds of things. And then cryptocurrencies, which you've probably heard of in the news, Bitcoin and those kinds of things. And then even real estate, that's another asset class. And so if you do work with an investment advisor, they might be able to help you to create a portfolio that works for you. But in general, a portfolio should involve multiple asset classes and kind of spread out your risk across different options. We call that, when you spread out your risk, we call that diversification. So if you have a well-diversified portfolio, it might be one that's invested in multiple different asset classes. And so you may have some real estate, you may have some bonds, you may have some stocks, you may have some mutual funds. Those are all different kinds of investments that you could have in your portfolio. And there's the old adage of not putting all your eggs in one basket. And that's the same thing here with diversification. If you, for example, have a lot of your retirement portfolio invested in high-tech companies, there's a thing in the investment world, we call them FANG stocks, and it stands for Facebook, Apple, Amazon, Netflix, and Google. And those are kind of the most well-known high-tech stock, companies that are publicly traded companies that are available. And they're very high-tech. And so if all of your portfolio was invested in those kinds of companies, and there was some major incidents that happened that affected technology, right? Some major like hack or some major news that happened that affected technology disproportionately to other industries, and all of your investments were in technology, well, you might have quite a bit of losses in your portfolio because of that event. But if your portfolio is spread out, even if it was, in mostly stocks and mutual funds, if it was spread out amongst different industries, that could be more diversification. Things like having, real estate and banking and healthcare companies and all kinds of other different types of investments in your portfolio. That's diversification. And that means, your eggs are in multiple baskets. And so you're less likely to be affected by any one scenario that happens to just one industry. So there are some long-term trends to be aware of as well. So in general, the old adage for the financial planning world is that the market tends to go up over the long term. If you look at the very long term of the stock market in the United States, typically the stock market tends to trend up at around 10 to 12% a year, and that's on average. Now, there are definitely going to be years where it's down quite a bit, and there will be years where it's up quite a bit. In general, over the long term, on average, we average around 10 to 12% a year. And so if you're looking for long-term investing, maybe retirement savings, or maybe just long-term savings for any purpose, if you're going to invest for more than 10 years or so, then you might be investing for the long term and might be averaging about 10 to 12% a year. Now, if you're going to invest in just a short time frame, then you might happen to pick the 1 year that you're investing for that it happens to be down. And so we can't take this long-term trend and say that every year the stock market will be up 10 or 12%, because that's simply not true. We all know from our own lives that the stock market has gone down in the past. And so that's just something to be aware of as well. In the short term, markets could be up or down, and no one can really predict the future. But over the long term, then the trend is generally up.
Jacob?
Yes.
If the market is going down, should I pull out all of whatever I've allocated?
So the thing is, we don't want to make emotional decisions with our investments. And so one of the things that I like to recommend, if you're going to be looking for, say, an investment advisor, and I don't recommend any one particular investment advisor, it's up to everybody to decide who or what firm is most useful for them. But one of the things that investment advisors bring to the table in terms of service is that they can kind of counteract emotionally driven decisions. And so when there is a bear market, when the market falls pretty drastically, the usual response from most people is to say, oh no, the market's falling, I need to sell all of my stocks, I need to pull everything out because I don't want to lose all my money. Well, if you look at, it's actually perfect that you asked, because the very next slide shows, if you look at this is a trend from the early 90s until late 2001, right, where we have this is what's called the S&P 500, which is simply just an average of the biggest 500 companies in the United States. And you can kind of see this green trend line, this bar graph or line graph here of what's happening. And so here is the dot-com bubble, right? And so we can remember from 2000, 2001, the dot-com bubble that happened. Many stocks that were called something.com were going up really, really fast because this was kind of when the internet was just getting around to being much more common. And then those companies were trending up pretty well. But then the dot-com bubble burst, and then there was a bear market. A bear market is when the stock market trends down for some amount of time. And so we're in a bear market, and a lot of people panicked and sold. Now, then between 2002 and 2006, the market rallied again, and that's called a bull market. And a bull market is when the stocks go up and do well for some period of time. In general, bull markets last a very long time, or a longer time than bear markets. Bear markets tend to be very quick. They end quickly, and then we start a bull market. Bull markets tend to not go up as fast, but they go up for longer. And you can see that there was a bull market happening from 2000 to 2007 or so. And then 2008 is when we had the housing crisis and the financial crisis and the Great Recession. And so the stock market collapsed. And so people tended to sell out. They panicked, they sold. And they sold out here during the crash. they would have missed out. And if they had stayed out, they would have missed out on this long bull market that's happened since 2009, the very low of 2009, all the way until even now. As of right now, in late 2001, this same trend here is continuing up, and we don't know what's going to happen in the future. There could very well be another crash. There could be continuing bull market. We don't know what's going to happen, but if we're willing to hold, this is a period of about 15 years. If you're willing to hold that long of a period, things tend to do pretty well. And so I think one of the lessons to take away from this slide is that, if you sell in a panic and you stay out, you're going to miss out on the long-term growth. And so I might see, when stocks fall, I might interpret that as, a sale is happening. Just like we might want to go buy something when it's on sale. When stocks are on sale, we might want to buy that as well. Now, obviously, this isn't, I've said before, and I think we'll continue to repeat this, that this is not specific investment advice for you. It's just something to think about, is that, if stocks tend to be going down, then you might want to look at, do I have an opportunity to buy at a discount?
Jacob,
yes.
I have a question going back to that previous slide.
Sure.
So those dips kind of do look a little bit scary. When should I reassess my portfolio? And are you saying I should do it based on my life versus what the market looks like?
Yeah, that's a really good question. So in the managing of an investment portfolio, we call reassessing it or reevaluating it. We call that, well, you call it reevaluating, but you can rebalance your portfolio. And so if you had, let's say you had a few different investments, let's keep it kind of simple and say you have stocks and you have real estate, two different assets that you could have in your portfolio. And currently, right now in Butte County, real estate pricing is doing pretty well, right? Housing prices are kind of on an uptrend. And so if you had a portfolio, but also stocks are on an uptrend too. And so maybe they're both going up, but maybe one is going up significantly faster than the other. Let's say real estate outperformed stocks. It went up a lot faster than your stocks did. Well, you might have a point where, you're unbalanced in terms of your goals. Let's say your original portfolio was designed to be 50-50 stocks and real estate. Well, if real estate goes up really fast, your portfolio might no longer be 50-50. It could be, 60-40, 70-30. It could be 90-10 if it's really significant. And so you might want to rebalance, meaning sell off some of that real estate in order to buy more stocks so that it comes down from that, 70-30 or 60-40 back down to 50-50. And you might want to do that every so often. And generally, financial planners recommend to rebalance maybe every 6 months or so, and that might be a good frequency. Typically, if you rebalance every maybe 6 months or even wait as long as a year and rebalance once a year, you're not doing it so frequently that it becomes a heavy burden to have to do it so often. But it's also not so infrequent that you have to do any drastic changes, right? If you rebalance once a year, you might have some more significant changes than if you rebalance every 6 months. But if you're in that time frame, 6 months to a year on rebalancing, then you probably don't have to make any really significant transactions, but you at least will keep up with what your goals are. And you definitely, when you go to rebalance, you're going to want to reevaluate what your goals are too. You may have met if you have multiple goals for your portfolio, you may have met some of those goals. You may say, hey, listen, I've reached this savings amount for my child's educational savings. They now have enough money that they can go to college and we can pay for it. That might be one of your goals. If your goal is retirement, then maybe you don't reach your goal until you actually are retired. But you might want to set aside, and say, this is the amount of money I do need to retire. And once you reach that amount, then you can pull that out and say, you know what, this doesn't need to be at risk anymore because I have what I've met my goal. And so I might rebalance my portfolio and I may put some into, savings for some other goal that I have at that point. And it totally depends on the individual needs of the investor, what those goals might be.
Thank you.
Yeah. So selecting investments now, in the interest of time and the interest of making these webinars available to the public and who needs to know what information, we'll cover actual investment selection in another video and how to decide which stock I might want to have, what kinds of criteria to look at. But I think the thing that I want to reiterate is that you in general, a well-diversified portfolio invested over the long term is a good idea. Generally, what we would say is 10 years or longer would be a long-term portfolio. That's a good way to look at it. A financial planner would be a great person to have on your side if you think you need that, if you need someone who has some experience and can kind of help guide you through those bear markets and help you to not sell everything when the bear market happens. But you should always consult with a professional before making investment decisions. So some of the conclusions that I want to make sure we all take away from here: be careful about choosing a broker. We all hopefully don't want to choose Bernie Madoff as our broker, but go look and see, what whether they're a broker or an investment advisor, what their history looks like and what they can do to help you. Holding investments for the long term is generally a good idea. Again, consult with a professional for your own needs. And then don't let emotions drive your decision making. You're going to want to be logical and take emotion out of your investment decisions so that you can grow wealth over the long term. And if you need to buy when the market's down so you get things at a discount, that's great. And sell when the market's high. You've all heard buy low, sell high. Well, that's the kind of thing that you want to look for in investing. So those are some things I want you to take away from this. I hope you learned a lot. And thank you all for coming.